Hello, my name is Samir Samal, and I'm your host today for The Topic at Hand, a CFA Institute production in which we explore different perspectives on critical issues related to the profession of investing and asset management. Coming to you today from CFA Institute Studios in Charlottesville, Virginia, The Topic at Hand is the mission of investing and what it means to manage wealth in the 21st century. To explore these themes, I'll be talking with our distinguished guests, Charlotte Beyer, Nell Derek Debevoise, and Sebastian Dovey. Let's quickly explore the topic at hand. Nell, what can firms do to ensure that their interests are aligned with client interests?
I think something that's really important to serve these humans who are entrusting us with their money is to really be conscious of the spectrum of capital, right? What are all the options that these people are thinking about with their money? It doesn't mean that each firm needs to be everything to everyone. Certainly, we know that's a bad business play, but you need to be conscious and your advisors need to be informed about the full spectrum of capital, by which I mean everything from philanthropy all the way through a balanced portfolio to public equities and absolutely everything in between. Because I think if you're not conscious of that full range of options and tools, it's very difficult to serve the client's true interest.
Yeah. In fact, I'd like to weigh in on that because I think this is the crux of the problem, perhaps. We have confused money management with wealth management, and they are not the same. But like anything that is sort of the sexy thing, the investments and money management and beating the S&P by X and making all this money, that's taken all the attention. And as a result, wealth management is not getting, it's getting short shrift and it's not being addressed. And that's another reason why firms have trouble putting in adhering to regulations.
Now, in thinking about how you align with clients' best interest, of course, there's ostensible needs in terms of metrics and what returns we need to receive. But what are some of the other areas that you oftentimes uncover in terms of being able to discover what truly is in a client's best interest?
Yeah. I think that it's important, again, for firms and advisors to have a sense of all these options, and so to really do the continuing ed and the homework of learning a bit about a lot of different areas, again, not to be everything to everyone or an expert in every field, but to get comfortable with some of the trends in strategic philanthropy and impact investing, for example, and even if one is a fixed income specialist, to know about the new emerging ESG filters on public equities, and just to make sure that your team is somewhat comfortable with all of these different options, so that when human clients are expressing an interest in something that may not be the core specialty of the team, that you can refer out maybe or have a brief conversation at least about some of the opportunities there. So certainly at Inspiring Capital, some of the content we think about is that 101, just demystifying this sort of spectrum of options because it's changing so rapidly. And there's a lot of exciting opportunity, but it can be daunting if you don't know a little bit about it, which doesn't help your clients or ultimately your business performance because you just can't speak to what's out there.
I'd just add that one thing we have to remember as an industry is that to the vast majority of clients, this is an overwhelming universe of information that they will have never had exposure or understanding of. And that is both delightful and scary. And the role of the wealth manager is to chaperone that client, reassure that client through that process of discovery, with an objective is that they will achieve a better return and objective outcome to what they have with their money. And I think occasionally the speed by which a wealth manager goes through from initial meeting to an execution of a portfolio misses all this vital educational part in between, just to make the client aware and assured that they're doing the right thing for themselves. It's already a solution before they've even had an awareness of what that solution is.
And in fact, I think that is what has driven the success of many wealth management firms, is they slow down the new business process. And they make sure, in fact, many investors have said to me, it was really hard to become a client of that firm. And so they're sort of proud when they become a client of that firm because they really did the due diligence on the client and vice versa. So they made it hard.
I think slowing down the process, obviously that has business consequences, but in fact actually the business consequences are positive because your client becomes more connected to what they're doing with you.
Exactly.
So I really like what Charlotte said there. Is we sometimes in this world that we live in today, everyone wants to move so fast. But for this type of issue, actually pace matters, and having the right pace is important.
And I would say largely in that slowed down timeline, what you're doing, what your teams should be doing is listening, right? Really listening. And in a moment of so much change and disruption, there's a lot more nuance. And you know, it is an era of mass customization where that's possible. We can really customize to people's needs if we listen and understand what those needs are.
On the other hand, the customer is not always right.
Yeah.
And I think most advisors in their exuberance to get new business forget that there are going to be times when you're not going to agree with your customer, or they may not even know, the client may not know what their best interests are. And so I think one of the things that the successful wealth advisor can do is say, what are we going to do when we disagree? Or what happens when I think you're going down a really wrong path? Are you and I going to be able to have a dialogue?
What are some examples of common industry practices, Seb, that do not align interests of clients and wealth managers?
I think we kind of touched on a little bit about the speed towards achieving the phrase, a product sale. Not that that's a bad thing, because fundamentally the economics of the business today is linked to the sale of some sort of product of whatever type it is. But the bad practice, in my view, is around the type of hollow communication that's passed to clients about how much the business cares of the clients, how much empathy it has with the way of their lives, usually with lots of wonderful marketing pictures of people on sailing yachts and so forth, that have no correlation to the reality of the individual. And actually, when you ask the wealth advisors, so have you read all of this literature that you say is important, then they haven't read it either. So the culture of the business is actually sometimes quite hollow, and that's bad practice. It's less of a case within sort of privately held wealth management firms, but it's more of an issue with those that are much, much larger. And I think that's probably the biggest issue. That's a common complaint from the thousands of clients that we interview around the world, which is, what I read isn't what I see isn't what I read. And that's a problem.
And scripted. Very often the investors will say, it was so scripted, it wasn't genuine. He or she was not authentic, was just trying to get me as a client.
Right.
I think people can spot and sense when somebody really doesn't care, but they just want the new business, you know, they want to bring in those new assets.
So there's humanity that's missing occasionally. And look, everyone has humanity, I would hope, in this industry, but it's about reflecting that in the way that you do business rather than just who you are as a person. These are the most valuable customers in the world, the wealth management market. They are implicitly, by value of assets, the richest people in the world. And they have the capacity to choose anything that they like. But one thing that they absolutely miss is being treated in a humanity way when it comes to wealth. And you know, that's the challenge for the industry. It's getting better, no doubt, but it's certainly a challenge that I think everyone has addressed properly.
But the pressure on the wealth management advisor or the firms is intense. There's this pressure to bring in assets, to be profitable, and then there's compliance and regulations. And so I have great sympathy or compassion, I guess, for the professional who's running as fast as he can, and yet the client doesn't like that. So we've gotten it out of kilter.
Now, can you spend a minute describing the evolution of outcome-oriented investing, from SRI to ESG to now impact investing?
Absolutely. I think what's exciting in my view is that we have come beyond thinking that this was some kind of niche-y, particular thing that certain individuals or families felt strongly about in terms of paying attention to the environmental factors, the social factors, the governance of the companies they're investing in, to a point where now increasingly folks are realizing that this is good business. It's important to think long-term about your impact on the environment, your human stakeholders. You know, what about your employees? What about your customers and their well-being? To say nothing of the governance of a company, right? We could cite many scandals that have been really directly linked back to governance breakdowns with extremely real financial costs to the company and shareholders. And so I think that we're not quite to the utopian future where this is how business is done, but I think we're getting closer and closer. And studies, 18-year study just released by Harvard, that indeed folks and companies that are paying attention to environmental and social factors are performing better over 18 years. This is not a trend. And so I think that to see that mainstreaming of this perspective is exciting.
The notion of money is not the reason, it is the reward. Seb and Charlotte, is the growing popularity of outcome-oriented investing driven by client demand, product marketing, or both?
I believe it's coming from the investor, the humans, whose money it is and who are looking out at. I love what John Glenn, the late astronaut, said about his legacy. He said, I don't want to have a legacy. I want to see something while I'm alive. I want a livacy. And his livacy meant that he wanted to see impact. And when I listen to investors today, they all have a very different view of legacy. They don't want to be stewards anymore. They want to really be active. They want to see things happen in what they can use their wealth for, whether it's B Corps or ESG investing or just generally impact. They no longer care about keeping as much money as we can for 7 generations. They want to have something in their world today change for the better.
Right. The issue of impact and social responsible investing and so forth, it's fundamental. It goes beyond wealth management. I think that's the first thing. And you can see it in schools, you can see it in the curriculum of education. When you listen to children today, when we survey younger investors, they will clearly indicate that this is an important part of their sort of makeup. Of why they would want to put money to work. I think so. It's an important piece around that. There's also a quote by an interesting inventor who said, "I'm interested in the future because I plan to spend the rest of my life there." The idea that we have a responsibility, and that can we achieve some of that responsibility through the way that we invest, and also the way that we act. So this isn't a fad. I mean, in wider life, we are trying to act more responsibly, and I don't think of that just as a Western world phenomenon. It is around the world. When I travel to all the different countries we go to, we can see it being manifested at every spectrum of wealth. So this is a fundamental way of doing business. Perhaps the one resistor of that happens to be the financial markets, or at least that research that's been referenced just now. I think that's very, very significant because the markets have opposed a lot of this type of investing as a niche, a sort of 5% allocation, something that you do as a hobby but not as a reality. Returns are achieved better elsewhere. Whereas actually it's a complete way of thinking, and it's you rationalize your return based on that way of thinking. And if you can achieve better returns with impact, well, to anybody, well, why not? And to the younger population coming through, absolutely. And I think we have to almost not have this debate anymore. It's in, and we need to accept it and embrace it into the process of how we do business.
I think that's where the challenge lies for professionals and advisors to get smart about this.
Absolutely, yeah.
Because I do think that tends to be now, when you look at the bottleneck, right? There's been chicken and egg, there's not enough deal flow in this space. Well, there's not enough capital for the deals. Yeah. I think that we're at a place where the gatekeepers are part of the problem, and they are bound by regulation and fiduciary responsibility. So it's not, that compassion, Charlotte, that you mentioned is real. It's challenging and it's scary, but there is an ethical responsibility and a performance responsibility to learn about those opportunities and be able to advise, because it's what people want and it's where returns are going to be gotten moving forward.
Begs the question in terms of impact investing and ESG is, are we seeing a cultural shift in investing and globally speaking?
I think we are, from the research that we do. It's not overweight, so it's not more than 50%. From all the work that we take on around the world, it's still in the minority, but it's no longer 5 to 10% of the population say that this is something they want to do. It's moving 25, 30%. And there is a very clear demographic to that. So the demographic of those under the age of about 45 are more attuned to this. There's still a balance of, well, am I going to get a better return on the sort of traditional way of investing, which is still a debate that has to be had. But it is moving. There's definitely a direction of travel towards a higher uptake of this being the fundamental way that people invest.
I've seen this live in the classes at Private Wealth Management at Wharton. The participants who come from all over the world, the ultra high net worth investors, are younger, and they are the leaders in this, just as you said, that they are saying, you know, my father or my grandfather just built a fortune but didn't really care, you know, who might get clobbered in the process. I don't want to operate like that. That's not how I want to be. And it's become, over the last 5 or 10 years, a real clarion call, and sometimes other participants in the class really support that. So often the very wealthiest are the leading indicator of what's going to come with the merely wealthy. And so I think that you're onto something with that trend.
So we're reassessing capitalism with this approach, and effectively it's impact capitalism. It's not, again, that the previous generations have been evil. It's just that the way of approaching to do business was within that generation and era, and that's now adjusting. So impact capitalism is the way that we're now looking at it. We haven't solved that, but we're moving towards it.
I think also we have to look back and remember that, you know, there was an era of very traditional capitalism paired with very serious, very generous philanthropy.
That's true.
Right, and so the notion of caring about the community, whether it's your employers in kind of the Ford model or the philanthropy sense of the Rockefellers and the Carnegies, that was real. And so I don't think we want to return to that, right? But I think that we are now at a moment of coming back to that sense of taking care of the larger community, just that it's more integrated now into the core of the business, rather than we'll be strict, you know, steely-eyed, hearted capitalists over here so that we have enough to throw around and build libraries. Right now it's a sense of what if we did that all together and had great, sustainable, profitable businesses that were good for the world at the same time.
Seb, are client motivations really changing, and do they really care less about rates of return than in the past?
It's not a case of caring less, it's a case of balancing the relative rewards and risks, which makes me sound like a wealth manager, which I'm not. But the principle what we see from the customer insight is that customers have quite a clear ambition with the money that they allocate to an investment manager or a wealth manager or a private bank, and you know, it's don't lose it, and to an extent also grow it based on these ambitions, whether it's my pension or my educational fund or whatever. Once they're in that framework, yes, some have unrealistic expectations about return, and that needs to be advised on, and some actually broadly say, well, you tell me what's appropriate. I'm trusting you in this process. I don't think performance is the sort of big driver of the relationship in its isolation. There's also the customer engagement, the customer experience, and to some extent the relationship over the longer term. So there's no single answer to that. But it isn't the way the industry sees it. They see it, everything is defined by a performance level, and that's not true.
Well, but I do believe that many of the investors expect and demand competitive returns.
Absolutely.
And they want it in graphic depiction. They want to see, they don't want to fall behind, they don't want to be a sucker, and they don't want to be taken advantage of. So those feelings, I believe, sometimes outweigh, and so to the extent that our industry comes up with ways, with metrics, so that we can show the impact, and the impact not only on the family and their goals, but also on their society, on the world. So it's just that we perhaps have a new challenge to meet. How do we better define it?
What is fintech anyways? Can we refine our terminology?
No, it's such an embracing question that, I mean, to some extent, obviously it stands for financial technology, but I mean, what does it begin? It's the beginning and the end of the entire process of delivering a technical wealth management solution. I think one of the things I'd say from a fintech is that wealth management and financial services broadly is actually a hugely technical industry. It's probably the third largest investor in technology of any industry in the world. It's always been technologically driven since probably about 1980 in the context of using machinery to help investing more efficiently. But what fintech is doing now is front office fintech. That's the difference. That's what's changing the market landscape today. It's how we engage with the client in the client experience through fintech that's radical.
I think, yeah, there, goodness save any financial organization that is not technologically driven at this point in time. And so I think there's a little bit of danger around labeling things fintech when it's just finance or asset management. JP Morgan spent $9.4 billion investing in their technology last year, right? So, but I think it can be a bit off-putting to certain clients, depending generationally on how you talk. And so I think that it's important to demystify some of the tech in some of the solutions that we have now.
Investors have been quicker and more rapidly adapting to technology, the older and the younger. And in my experience over the last 30 years, the advisors have been behind the investors. They didn't realize that investors might like 24/7 access to their portfolios. They didn't realize they would prefer email, that they didn't realize that they were perfectly okay with virtual meetings, GoToMeeting. So I think those are lessons that the industry needs to remember.
And I think to that point, that user interface piece is so critical, and that's where some of these from nowhere startups are really winning because they have these magnificent, easy to use apps and dashboards, whereas the technical folks, whether technically technical or financially technical, complicate things with too much information and too much complexity in a way that really isn't meeting clients where they want to be.
I think one thing the industry generally needs to understand is that fintech is not shorthand for cheap. Or cheaper. It's actually shorthand for better quality. That's how we need to approach it. Not many are doing it that way, but fintech is an enabler for a better quality of relationship because it manages information more effectively. We're at the foothills of that development process in the financial services industry for wealth management, because there is still, as Charlotte's just mentioned, a vast sort of group of wealth managers that haven't really quite understood yet how technology can enable them to be even a better relationship manager. They've resisted this process of change on the basis that their value proposition was themselves. Clients don't deny that they are important to that process, but how can technology make it even better, not cheaper? And that's something that we have to rationalize now in the industry.
Nell, how much of the growth in fintech is about better meeting client needs?
I think that this gets to some of your points from before, that technology can do incredible things for us in terms of assessing, analyzing data and tracking data over time, and the power that we have there to understand that level of information is incredible. Technology does not yet, and for quite some time I don't expect, have wisdom or judgment. And so I think that if you leverage technology to do what it's so good at, that then frees up these very intelligent, nuanced, well-trained professionals to serve the nuance of those real client needs. Going back to those questions of what is your high-level goal other than 7.2% post-tax in 2018? And a robot can't take in, I want to be sure that my grandchildren have some affiliation to our local community museum, for example, or I want to change the ratio around acreage of rainforest being devastated. Some of these bigger things can't possibly be crunched by the bots that are picking stocks. And so I think using technology where it is placed and using that freedom to do the more human tasks of judgment and wisdom is where we can get better at serving clients.
I want to put in a good word for R2D2. Friendly, willing to help, helps you do the complex and simple tasks that you don't have time to do or you want to spend time doing other things. And I also would predict that, to call on Ray Kurzweil's vision of the singularity, that's where we're going. And I think the clients will appreciate having robots, and in the case of the ultra-wealthy, having singularity that really tracks everything, tells them what's happening, gives them instant, the way that the Internet of Things has helped us, heat our house and start the car and turn off this and the alarms. I think this is happening, and I remember working in a money management firm the first time we were able to do simulations and say, well, what if we bought 3% of Apple here? and zzz, it was done. I think this is coming in the client-advisor interface, where it's already, by the time you're sitting with your advisor, the advisor already knows a lot of what you've done, thinking, because of technology.
It's already here. I think the argument that many in the industry have about technology is that horse is left. You know, there's a very nice quote that was a part of an Apple campaign on branding a few years back, which said, "Once we get the technology out of the way, things become delightful." And wealth management has to let go of its shackles of the past and say, well, how do we use technology to enlighten the relationship that we have with our clients? I mean, I do actually, some of the think tank work that we do with our institution around the world, we are anticipating a world where there is information being managed to prompt and proact with a client around what they might think that they hadn't thought about. That's why the simplest way that I communicate that back is think like a publisher, because clients are tribal. Maybe anybody is a tribe. Have you done something that someone else has done? One of the areas that we think is probably the most radical transformation that's going to come to the industry in the next 3 to 4 years is around ratings of the wealth managers, of the advisors, and that's going to happen through technology. Because the data will be there to say that, Samir, you're a 5-star advisor because you've got these experiences with your clients and these qualifications, but you know, Mr. X is at a 3-star. To a consumer, that rating score is going to be as important, if not more so, than the fact that you were at 7.2% yield last year versus 7.1 at someone else's. Behavior is going to be what the digital world is going to track the most effectively. But I would argue that our industry is a little bit slow on the uptake about what technology can do for it.
And only because they thought it threatened their business. Absolutely. And if you think about it, EQ and IQ. So far, artificial intelligence hasn't mapped totally EQ. So that, in your words, judgment and wisdom, EQ is the ability to communicate and to work harmoniously and to really have that very special sauce, I guess. So that the technology on artificial intelligence can clearly make leaps and leaps on all the information. But to communicate it, to make the changes necessary, those are the things that are going to be the big challenges. And firms that invest in helping people have more EQ or bringing on people to their firms who have it will be rewarded.
My question, maybe starting with you, Seb, are there any areas in wealth management that we can say with certainty that exist today that may not exist tomorrow?
Ignorance is something that will go. I thought about this before. I mean, to some extent, the fact that we have more data, more insight that we can look at about the behavior patterns of our clients, not at a binary level of one relationship manager with one client, but at a business level, will allow us to do things very differently because we'll be running a business. Many of the private wealth businesses that I've worked with over the years have been constrained on growth because they've just thought about the binary relationship on one advisor to one client. They haven't thought about how they run a business. So FinTech allows us to look at the numbers more effectively. That isn't managing a business by numbers, but it's using that intelligence so that we're no longer ignorant about how our business is evolving. And that's a big challenge for quite a few of the markets because received wisdom is, I know best, so no one else should tell me how it should be run. And I think that ignorance is just a constraint on growth.
Let's briefly touch upon robo-allocators. Does the impressive growth of robo-allocators mean that the wealth management business is in the process of being disrupted, and what are some of the ramifications of the very same?
Is it impressive? I'm not... the uptake from the work that we've done, the allocation of the role of the robo as the primary advisor is still less than 1% in the US. Now, granted, it will grow, and I think, but as it grows, the robo world will evolve too. What's important is that robo has forced the industry to reconsider its value proposition, what it's valuable for, and what its value is to the clients. Yes, robos have grown, but I don't think it's as impressive as people have said. I think what's actually been more impressive is how the rest of the industry has responded in a way that embraces technology better to engage with clients. It's still a lot of work to do, but I think it's not as dramatic that robo will take the world. That's not the way to look at the problem.
Is there a gulf between professionals' perception of tech and client perceptions, and how can professionals adapt?
The recent work that we've been doing for the CFA would suggest that there is a gulf in from both sides. So the clients are sort of feeling through the dark, saying, "I know that technology can do more for me, but how are you going to show me how that enables me?" Because as a client, they'll see how technology helps them in other aspects of their lives, whether it's through Walmart or whether it's through American Express, or the information flow is managed and they engage with it. But in financial services and specifically in wealth management, it's a bit of a wall still about, or it's very static, the way that content is put back to them. And from the other side, the professionals, there's a certain sense of fear of what technology is going to do, which is are we going to become more transparent? Are they going to know how we actually operate? Does this mean that we've got to justify more of our existence than we did previously? And is it going to take up time that I would rather do doing other things? So yes, there is a gulf in perception. But I think, look at it in a more positive way, is that both sides desire to use technology to have a better connection. They are both solving for the same issue. The customer wants to have better information to do better things with their money, to have better outcomes. And I would argue that the technology side of the wealth manager is exactly the same. But the gift is in the hands of the wealth manager to change. And that's the key.
I would underscore the idea that investors love technology. In my experience, the newest, coolest thing, many of the ultra-high net worth want to try it. And if you think about it, looking at your account at midnight and saying, well, what if I did this? And how am I doing over the last 5 years? Not the last 2 days, but the last 5 years. And being able to do that user interface and find it out without having to call my relationship manager at midnight on a Saturday, I think is tremendous. And it's of value, and the wonderful variety of things that one can do now with the client portal. They're really very, very valuable to the investor. And those firms who are ahead of the curve on that are finding it very productive and rewarding for their firms.
But the step beyond that, again, for the industry to take on board is, you're right, the customer will want to interface with their content. But the opportunity for the wealth manager is to follow the trace. Yeah. So that the next time they have that face-to-face conversation, it'll be, Charlotte, it's very interesting, in the last 7 days you've been looking at the S&P. Right. Also interesting, you've been looking at 11:50 at night. Are you worried? Or is this just part of your life pattern? You know, just want to know that. And so from the consumer perspective, it's like, wow, you really have a relationship with my interaction with you. And in the past, that only ever happened when you met. Right. Now it's happening so you can see it in every aspect of their lives. Again, the responsibility is to make use of that ethically, responsibly, and for the positive outcome of returns. I think there's a wonderful gift with respect to technology for all operators.
I'm sorry.
I think also to think holistically about the technology. Again, as financial professionals, it's very easy to get into the weeds of the algorithms and the predictive nature and all of that on the technical financial side, which is fantastic. And probably when dealing with non-technical, non-investment professional clients, not the first thing they think of when they're thinking of technology. It is the interface and the manipulation of the data and the presentation of that content. You know, as a publisher, if that's what we're going to become, how do you present this information in a palatable way? Because the consumer experience of technology is that, right? It's flashy, it's video, it's smooth, it's easy to use and appealing to the eye. And so I think it's really important to take some of the wins from maybe some other sectors that are doing a better job in that way to make the information digestible and easy to use rather than deeply, radically technical.
That's so important because each client is unique. And there's this inherent conflict between our business will be the most profitable if we can put everyone on an assembly line and an autopilot. And yet there is going to be the client that won't want the user interface at all. And then there will be the one that will be on at midnight. To the extent that a firm is able to adapt, and one of the ways they do that is by getting to know them before they become a client. So they don't take the techno file crazy when they don't have the technology to back it up.
in thinking about wealth managers in the future and what skills they need in order to thrive, in order to continue their success. And any comments on advice for the wealth management audience we have here today?
Well, just one significant piece from the work that we did recently for the CFA, 90% of the under 35 population indicated that they would choose a wealth manager in the future based on their qualifications. The qualification standard mattered hugely in the selection process. So that's my biggest, and how you communicate that qualification standard is crucial. It comes back to this idea that technology is not replacing people, it's embracing people and it's enhancing the relationship. So it's that factor, that particular data point is probably one of the biggest things about the change in the market for the future. Technology is not desensitizing our market, it's upgrading it.
I would say, in a word or two, that the professionals who are courageous, so that the advice would be to be bold, have the conversations that may be a little bit uncomfortable early on, ask the questions like, what do you care about? What does success look like for your family? And be willing to hear and have a give and take. The courage is tough, because with all the other pressures on these firms, and if they don't have people who are excellent communicators, it's tough. But to be bold, have those conversations.
I think I would say it's really getting smart about the spectrum of capital and all of these options that are emerging. I think, people say as a teacher you need to just be 1 week ahead of your class, right? And so there's so much changing and a proliferation of information, so I think that's intimidating. But take comfort in the fact that you just need to be 1 week ahead, and so let that be a more less intimidating invitation to really understand the scope of what's out there, so that you can relate to clients on everything that they're thinking about. Because I just think that that narrow niche approach is not going to satisfy or retain clients in this interconnected world that we live in now.
Well, Charlotte, Seb, Nell, I want to thank all of you for sharing your perspective and your thoughts today. It certainly was helpful for me, and I'm sure our wealth management audience will feel the very same. Thank you so much.
You're welcome.
Thank you. Great to be here.
Thanks for watching this episode of The Topic at Hand.